What's going on, guys? In this video, I want to really emphasize and stress how trading is nothing more than probabilities, okay? Also, position sizing is everything. For those of you guys who are in evolution traders, who are trading with me each and every single day live in the webinars, you guys hear me talking about position sizing a lot. I'm always talking about some of us are oversized, some of us are not even paying the tuition to even see if the move is going to play out in your favor. Now, again, let me first start by emphasizing that it's always great, okay? And the chart we're looking at, by the way, is the NQ. It's always great when we play minis and we win, right? The wins are large. Even if we're playing multiple micro contracts, the wins are rather large, okay? They're rather large. So it's easy to kind of get caught up in the whole situation of if I just play the NQ for 10 points or 15 points or 30 points, I see it running 100 points in a day. If I can just take 50 of those points and I'm playing X amount of contracts, I'm going to make all this money and be rich. The truth of the matter is that regardless of what strategy you're playing, regardless of, what your edge is, you're always going to be in a trade that's going to run into drawdown. You're always going to be in a trade that loses. No strategy on the face of the earth is ever not going to have drawdown. Now, the one thing that is going to stunt your growth as a trader is being oversized, because like I mentioned in the beginning of the video, trading is nothing more than probabilities. So when you start to understand that, right? When you start to really wrap your head around the fact that it's not about this one particular trade that I took or am in, it's about the next 20. It's about the next 100. It's about the next 1,000 trades. The whole goal and the idea of day trading and scalping is to be able to have the capital to withstand the moves, to allow yourself to be in the game for a very long time, allowing your edge and probabilities to weigh in your favor. Now, the problem that a lot of traders run into is they get into a trade and they think that their sizing is not large, because when they win, maybe they win $100, or maybe they win $200 or $300 or $50. So they think that they're going to be able to emotionally withstand the drawdown if and when it gets to that point. However, most traders, 95% of traders, as soon as the trade goes against you and as soon as the trade starts to go red, you start to panic. You start to get frustrated. You really start to overanalyze what exactly is going on versus just understanding that it's just a period of consolidation or a period of drawdown or a period of distribution, or quite frankly, the trade's just losing steam and not going to work. So the point that I want to make here is I really want to back test, okay? I want to back test and I want to really show you guys from the market open until at least the first 2 to 3 hours of the market, right? After the market open, right, of the session. So if we realistically look here, at 6:55 in the morning Pacific Standard Time, we get a setup over the 20 SMA that is looking like it's approaching some of the previous pre-market highs here on the NQ. Now, for those of you who are putting limit orders right at the top candle and getting in on that confirmation, especially the last week, 2 weeks have been experiencing drawdown, okay? So what's happening is that you're getting filled and then immediately 30 seconds, a minute later, it's going against you. And that's causing a lot of commotion. It's causing a lot of fear. It's causing a lot of panic. Also, you're oversized and you're looking at the P&L, and maybe you're trading on a prop firm account and you're thinking to yourself, I can't have this much drawdown. I've got to get out of the trade. Next thing you know, 30 minutes later, it's going in the direction that you seemed to think that it was going to go in originally, causing you to now look for new trades that necessarily the setups are not there, and it's causing you to get stopped out again. So what's happening is you're rolling this snowball, okay, up the hill. And you're getting to the top of the hill, and then the snowball starts to fall down and get larger and larger and larger and larger. And the analogy that I'm making is that you're stopping out for maybe a small loss or maybe an oversized loss because of your position sizing. You're chasing a new trade, so you're just digging yourself into a deeper, darker hole, okay? Instead of being position sized accordingly and allowing probabilities to work in your favor or completely stop you out based on the chart. Now, this is probably one of the hardest things to do in trading, is to A, hold a runner, or B, hold a losing trade until technically you have no reason to be in the trade whatsoever. So if we look at the first trade setup here, over, meaning we're going to be looking to go long at 6:55 PST. We get confirmation at 7 a.m. and immediately pulls back, okay? Immediately pulls back. Now, this question or comment was brought up in the Evolution Traders live webinar this week, where it was stated that prop firm traders cannot hold through drawdown on wicks because we don't know how large it's going to be. My answer to that is you can, if you're sized appropriately. Now, if you're playing mini contracts, you most definitely are probably not going to be able to hold a significant drawdown because it's going to liquidate you. You absolutely need to be playing micro contracts and allowing yourself to build a cushion so that you can withstand the drawdowns. I'm going to play out two scenarios. This scenario here confirms at 7 a.m. PST. Okay, the price of the NQ was 14,951. Now, within this 5-minute candle, it immediately drops down all the way to a price of 14,922. So we're talking about a 30-point drawdown. Now, someone who's playing mini contracts is either going to get auto liquidated. They're either going to have a huge loss that they're no longer going to be able to trade their account properly on. Or if you're trading too many micros, it's going to cause you to take a little bit of a bigger paper cut loss than you would like to see. Hence is going to cause some confusion later. It's going to cause some hesitation later. So let's continue to play this out. If you were playing, let's use the example of two micro contracts, and this is down 30 points, you're going to be losing around $60 per contract. That's going to put you in the red around $120 to $130, give or take, right? Now let's continue to play this out. The next candle here at 7:05 begins to spike. It catches support here at the 50 EMA and off this 100 down here, begins to spike, goes over your initial entry of 951 and all the way up to a price of 964. Now there's two scenarios that could have happened in this particular situation. Someone who's looking to take anywhere between 8, 10, maybe even 11, 12 points would just get out of this for a very quick and small win, okay? What's going to happen on that 10-point win, right? What's going to happen on that 10-point win is you're maybe going to be up anywhere with slippage and fill time. You're going to be up anywhere between $25 and $40, give or take, somewhere probably around $30 on two micro contracts. Now, a lot of you are going to start to think that's nothing. Why would I take $30? Okay, fine. So if we continue to sit in the trade, the next candle opens up and proceeds to push down. Now that fear and those emotions start to brew again, and maybe you start thinking about cutting the trade. Maybe you start thinking about, well, this is pretty close to a 1-bar stop here, give or take 5 handles or so. If I cut this trade now, I'm going to be out clean and clear. And most of you are cutting this trade right here, right now, because you're oversized and you don't like looking at that drawdown and you're trying to protect yourself because you think you're doing a great job. Let's play it along. 7:15, this candle continues to confirm your 1-bar stop. Now, again, I tell all my traders, if we're going to pay the cost of admission to get in the trade, we have to, 100% have to, technically let the trade stop us out, not wick us out, not flirt with us, not tease us. So what's going to happen here for a lot of prop firm traders is they're going to get out of this trade because it's broken the 1 bar stop rule, and it's now trading below to the next demand, which is the 150 simple moving average. So it's going to be at this point where you're going to take a loss. You're going to start second guessing whether or not you know what you're doing or understanding of the whole concept and strategy. And you're going to feel really great about yourself in the end because you're going to say, you know what, I stopped myself from a fantastic, potential, humongous losing trade. The only thing I'm going to tell you is that the wicks don't matter, okay, when it comes to your stop loss, because you can get wicked out, get out of the trade, and let's continue to follow along. If you were to get out on the wick below your 1 bar stop at around 14,921, your entry price is 14,951. So we're talking about a 30-point period of drawdown from this entry here, to all the way down here, okay? So this move to the downside immediately after you get in on 2 micro contracts, okay, 2 is going to put you down around $130, $140, $150, give or take. Now you're going to stop yourself out here because you want to protect yourself, because a lot of traders think that they're smarter than the market. And look what happens after that. It pushes off this level of demand, starts pushing back to your entry, comes back to back test the 20 and 50 SMA, and then completely explodes to the high side. Now, if we look at the entry of 951 to the explosion that we had on this particular candle at 730, we go all the way up to a price of 14,992. So essentially, if you would have just respected the strategy and respected the charts and respected your position sizing, you would have been able to stomach $130, $140, $150 drawdown on 2 micro contracts, and you would have actually been up and taking $120, $130, $140, even $160 in profit on this one particular trade. Now, I tell my traders also to trail your stops with the 5 and 10-day moving average. So if we don't sell at this top wick and we want to squeeze a little bit out of this trade, we back test the 5, we give away a little bit of profits. We still stay above the 5 SMA. We then push higher to a price of 15,008. Now we're talking about a 50 to 60 point move. For a lot of traders on 2 or even 3 micro contracts, we're talking about a $200, $220, $250 win, depending on your position sizing. If it's small enough to withstand the pullbacks, this could essentially be a one and done trade for the day. An extra $200, an extra $150, an extra $250, an extra $300 is a fantastic open. It's a fantastic morning. And I would suggest everyone to probably just call it a day, because why would you want to stress yourself trading all day when you just took $200 out of the market within the first hour to hour and 20 minutes of the day? Because what happens is when you stop yourself out here, you see the move going again, you have another setup here, you're hesitant, you miss this move, you tell yourself, I should have been in this second move, right? This is what happens. This is what happens. You get into this trade, you prematurely stop yourself out here. You see this setup happen, you don't take it in fear of it doing the same thing again. Then you see it work in your favor. You see a new high of day, you get in on the new high of day, and then get shaken out because you don't want to put up another loss, or you hold this and then it does come back to truly stop you out. And now you're 0 for 2 on the day when you could have been 1 for 1 on the day and laughing at everyone else in the market still trading. I told my traders this week that, why do you guys think that if I hit a trade within the first 30 minutes to an hour, normally I'm done posting P&Ls, normally I'm done trading, I'm just watching the charts? Is because I do this full time. I can't afford to give back profits if I have a $400, $500, $600, $700, $800 day. I can't afford to do that. I have a mortgage, I have a car payment, I have insurance, I have a son that I need to provide food for. I have all these other things going on in my life where I can't afford to sit here on my stump and continue to trade because I want to be some sort of rock star trader. I can't afford to do that, because it would be devastating if I lost all of my profits on a $500 day or $300 day or $600 day and gave it all back and then go into the drawdown. It just puts me in a bigger, deeper, darker hole. So again, a lot of times you stop yourself out prematurely. You hesitate to take this trade because you're still in fear. You see a new high of day, you take this trade, and then you get stopped out for the second time. Then you're asking and wondering, why are you not finding the setups? Well, because you're not no longer jumping out of the first floor, right? The first floor, you're jumping out of the 10th floor up here at a significant level of 5-minute supply at the linear regression. Then you see it set up again. You take this trade. It's not enough money for you because you want more money and it never broke the high of day. So you're kind of waiting for it. And the next thing you know, it rolls over. And by the time it rolls over, you're so sad that you don't take this trade. And it was a beautiful trade. Now, in this video, I want you guys to notice how mindset is everything. Confidence is everything, because the market is playing on your emotions. So if you're taking trades and you're getting yourself stopped out, you're losing confidence to take the winning trades. You're trying to chase trades, getting stopped out, feeling like you're overwhelmed and don't know what you're doing. Take another trade again to give yourself that benefit of the doubt, get stopped out for the second or even third time. And then now you're scared once again to take a huge winning trade. You see how that works? So position sizing is key, and also probabilities is key. You're never going to win every single trade, and you're never going to lose every single trade. Now, you will lose and be out of this game if you're oversized and can't afford to trade anymore. So instead of trying to make $500 a trade or $800 a trade, how about we start off making $100, $150, $200 a day, a trade, multiple trades, and we call it a day. And we do that for a week, and we do that for 30 days, and we do that for 60 days, and we do that for 90 days. You're going to look back and you're going to see the level of progression and confidence and comfortability stack miles beyond belief, to where when you do run into a losing trade, you shrug it off of your shoulder and you continue to find the next setup, because you've already had enough trades to understand that this doesn't last long. I'm still going to come back, and I'm still going to take a paycheck at the end of the month, the end of the quarter, the end of 2 weeks, the end of the week. Probabilities are everything. Emotions are everything. And position sizing is the biggest thing that you can work on as you're building the foundation to building a cushion on your trading account. Guys, if you want to trade with me each and every single day live, you want access to my courses, you want access to live webinars, you want access to the community, the chat room, so you can trade with other traders who are doing this and working on the same issues and problems and also having success. The link down in my description, I have one spot left. If you guys want to take me up on it, it's one spot left to join the room. First come, first serve, obviously. If you don't and you want to sit on the sidelines and you want to continue to ask yourself questions in the dark, sitting in the corner, be my guest. I will be back on YouTube for all of you guys as well. Like, comment, and subscribe. I'll catch all of you guys on the next video.